This is FRM Part 2, Book 2, Credit Risk, and the chapter on credit risks and credit derivatives. We'll go ahead and spend a few slides at the end of the slide deck on credit derivatives, but the bulk of our conversations here today are going to be on the credit risk of a bond issue. And we're going to try to make life simple by just using a zero coupon bond, but then we'll talk about senior bonds and junior bonds as well. And if we look at these learning objectives, by far, at least to me, the most interesting one is the first one, and this is where we're going to spend a lot of our time. Calculate the value of the firm's debt and equity and the volatility of firm value. So there's a calculate action word, and so we'll go ahead and do some math. And I'll show you the likelihood of this showing up on an exam. And then notice the rest of these learning objectives. Explain and compare and contrast. So we'll talk about credit spreads. We'll look at senior and subordinated debt. We'll take a look at some contingent claims and the probabilities of default. And we'll use a little bit of the material that we've examined in recent chapters. And then we'll end with some slides on some credit derivatives. Now, what I want to do is introduce a model to you that does not show up in the chapter, but I thought would be a good idea for us to get an overall sense of exactly what lies ahead in the chapter. I'm guessing that those of you who looked at the chapter, and if you scroll through it just quickly, boy, there's a lot of equations, a lot of notations, a lot of graphs that are not just a simple upward sloping graph. And so what I wanted to do is take a step back and kind of give you a basic introductory model so that you'll have a better understanding of the models that we'll use the rest of the slide deck. All right, so bear with me here for just a few slides. Again, this is not in the chapter, but I think it's quite helpful. Here's our simple model. Let's suppose that a bank issues a 1-year zero coupon bond and raises $95 today with that zero coupon bond. The bank uses that $95 plus $5 in bank equity capital to purchase a $100 collateralized debt obligation. All right, so if you just look at the balance sheet here, assets equals liabilities plus equity, we have 100 equals 95 plus 5. All right. But what we're going to do in this chapter, these are called structural models because we're looking at the capital structure of a financial institution. We need to decide what's going to happen 1 year from today. All right, now what do we know about that CDO? Now, just to make life simple, let's not worry about what particular slice or tranche that CDO is. But of course, what we know over the course of this next year is that CDO is going to change in value. Maybe we have expanding or contracting economies. Maybe we have rising or falling interest rates. But clearly, that CDO is not going to stay at $100 worth of value throughout the next year, right? So in 1 year, the bank is going to have to make a decision. It's going to decide whether to pay off that zero coupon bondholder and then retain ownership of the assets or turn the assets over to the bondholders in the form of a default or bankruptcy. And that decision depends entirely on the market value of the CDO on the maturity date of the bond. All right, so let's do this really quickly here. And I do have some math on the next slide. If the market value is $110, then what the executives of the bank will do is pay off that $100 zero coupon bond and then retain full ownership of the asset, of the CDO, right? Think about it this way. The bank is going to pay $100 to gain full ownership of an asset that's worth $110. That makes perfect sense. But if the market value of that CDO is only $90, then why in the world would the bank pay the bondholders $100 to own an asset that's only worth $90? This is the definition of default. I think in the mortgage market, they call it being underwater. So here's the deal. Note that the decision by the executives of the bank, which, remember, the goal of the bank is to maximize shareholder wealth. maximize the value to the owners of the business, this works just like a call option at the expiration date. What's going to happen? We're going to exercise the option and pay off the bondholders and then take possession of the asset. If it's a simple stock option, we can exercise the option and buy it from the option writer for $100, and then we could go sell it in the market for $110. Now, we don't really want to do that with a collateralized debt obligation, although we could. But do you get the sense then that if the market value of the asset of the CDO is only, well, what do I say in this slide, $90 or $80 or $70, you're going to allow that option to expire. And that's the definition of default or bankruptcy. Now, the more interesting question is how to value the bank during the time until that zero coupon bond matures, right? So I have written there what I just talked about a second ago. We have changing economies and we have changing interest rates over, let's say, 6 months after the bond was issued. Let's suppose that the relevant interest rate is 6% and the market value of that CDO 6 months from the bond issue date is $103. So depending on the tranche of the CDO, maybe all of those people inside of the CDO who borrowed or who were part of that loan, maybe they've paid everything back, right? There's been no defaults, there have been no delays, there have been no timing issues, and so the value of the CDO has increased. All right, so what can we do? This bank can be valued in the following manner. All right, so notice what I did there. I'm going to take the $103, which is the market value of the assets, and I'm going to subtract the present value of the bond issue. And that's going to be the market value of the equity. And if I use continuous time finance there, I raise it to the 0.06 times 0.5, which is a half a year. Make sure you put the negative sign in front of that to signal present value. And so the equity value of this bank is $5.96. What that means then is that those shareholders who own the bank, their value is $5.96. So that gives them the right, but not the obligation, to pay off the bondholders in 6 months' time, because remember, we're assuming in here that that zero coupon bond is secured by the assets that the bank invested in. Now, the bond price is just simply the present value, so that's $97.04. So the total asset market value is $103, right? We said that up in the question stem or in that paragraph right above, so that's $103. So note how cool this introductory model is, and it's, by the way, it's a very simple model, is that the equity value, the capital of a bank, is the difference between the market value of the left-hand side of the balance sheet minus the present value of the top right of the balance sheet, which in this case is a zero coupon bond. And in this model, let's just assume that the bank has no other assets and no other bond issues. And it has just that simple equity structure of $5 to begin with. So think about what happens. 6 months ago, the bank owners provided $5 in capital. 6 months later, now it's worth $5.96. All right, so that bottom equation there is going to be really important. I'm going to refer back to that as we go through this a little bit more complex model in the next couple of slides. All right, so what have we learned here in this introductory model? That the value of the equity can be viewed as a call option on the equity portion of the balance sheet. And it's equal to the difference between the market value of the assets and the present value of the bond issue. All right, so let's go ahead and get into the chapter. Your chapter starts with this Merton model. And of course, this is Robert Merton, who is famous for his contributions to the Black-Scholes-Merton option pricing model. And we're going to, in fact, use that model here in the next couple of slides. So let me go ahead and just read these first two to you so that I can link them back to those first two slides. The Merton model is used to assess a company's credit risk by modeling the company's equity as a call option on its assets. All right, so if I go right back here, there's the equity value. It looks like a call option. Now, it's built upon the Black-Scholes option pricing model, and what it intends to do is establish a link between the default and a firm's capital structure. All right, so think about the right-hand side of the balance sheet, the bond issue up top, the stock issue in the bottom, and how that relates to the market value of the assets over on the left-hand side of the balance sheet. One of the cool contributions of this model is its emphasis on market values. In a previous chapter, we looked briefly at the balance sheet and the income statement for Nike. I believe it was Nike. And those are historical values, and they may or may not be market values. They're probably not. But this model is a focus on market values. And so that's why we're operating as a good financial analyst, as a good credit analyst, and as a good risk manager. Because our focus is on not historical accounting values, but market values. Now, we're going to ignore dividends, so let's just suppose that the firm pays no dividends, and there's only one liability claim, like that 1 coupon bond in my first example. And then we've got to go all the way back to 1958 when Franco Modigliani and Merton Miller, introduced their theory of the firm and the capital structure irrelevance proposition. And they came up with all these very limiting assumptions, like the markets are perfect, no taxes, no transaction costs, or no other contractual costs. And let me remind you is that, this M&M world back in 1958 was considered to be totally unrealistic, but their focus was not really on those limiting assumptions. Their focus was on how to value a company. And so Black-Scholes and Merton have taken that a step or two or three further, but they've retained some of those initial assumptions. Now we can relax some of those assumptions over time, and we'll be able to see how valuable those limiting assumptions are. All right, so let's go ahead and use the notation from the chapter so that you can use the chapter, as kind of a source here. So let's assume that the firm has a single outstanding 0 coupon debt with a face value of F. All right, so that's no big deal. We've done that. We've done that in my simple example, payable at time uppercase T. Two possible scenarios. The value of the firm at the maturity date of the 0 coupon bond could be large enough to pay off that principal amount, in which case the shareholders have a claim over the balance. All right, so that's exactly what we did in that very first example. On the other hand, though, the value of the firm could be insufficient on the maturity date of the bond issue so that the firm is unable to settle that principal amount, in which case the equity holders receive nothing, right? When you allow the option to expire, nobody shows up your door and say, hey, here's $10 for your trouble, right? When you allow the option to expire in a stock option, you get nothing. Well, the same thing holds true here. All right, so the value of the equity is going to be equal to the maximum of the difference between the market value of the assets, there's the VT, and then the market value of the 0 coupon bond, and this is at maturity, so we'll just use that capital F. So it's the maximum of the difference between those two, or 0. So look in my little clouded my little clouded sentence over there. The payoff is a call option on firm value with the exercise price as the face value of the debt. All right, nothing too fancy mathematically here. And then I'm guessing you guys would know this. Here's a great picture of the payoff for a call option. Notice that when the value of the underlying asset is low, that value is going to be constant, right? But then as the value of the asset increases, well, then we go up at that 45-degree angle going outward and upward. Assuming we could go all the way out to infinity, but I've never seen stock prices or market values reported as an infinite amount. Let's take another quick example here. Suppose that a firm has 0 coupon debt and requires it to make a payment of $160 million to the bondholders, no other creditors. Let's take a look at two cases here. Case one, the total value of the firm at maturity is $180 million. This relates to that CDO in the first example. Estimate the value of the equity. So skip down to case one. All we need to do is take the 180 minus the 160, and the value of the equity is going to be $20. That's the value of the call option. The shareholders have a call option on the assets of the business. Now, on the other hand, if the value of the firm at maturity is only $140 million, well, then the max of 140 minus 160 and 0 is going to be 0. So we allow the option to expire. In other words, the shareholders, they default on that 0 coupon payment, turn the assets over to the bondholders, and then what do the bondholders get? Right? The bondholders have a future value or a face value of $160 million. But the assets, when they're turned over to them, they sell them for only 140. So they have a loss. I mean, this is not good news for the bondholders. And this model illustrates that the bondholders and the shareholders are not happy during times of default and bankruptcy. Now, what we can do is use this model to value the debt. And the way to do this is to combine risk-free securities with derivative securities. And this is really a cool example of how this works. All right, so let's work through these block points at the top. If we assume that the debt is risk-free and that the principal amount F is guaranteed to be repaid, then the payoff is going to be F, right? No matter what happens to the value of the firm, way up or way down, if it's risk-free debt, then we're locked into that maturity payment. Now, of course, the only risk-free security out there are those securities issued by the U.S. federal government. So if we're talking about a corporate bond here, which in fact we are, notice the second block point, in the presence of risk, all right, so the debt holder is going to receive an amount lower than that anticipated value. It's going to be less than F, right? And so this makes perfect sense that if the value of the firm is less than F, then the amount received by the bondholders will be reduced by that difference. The principal amount of the bond issue minus the value of the firm. Now, take a deep breath. Are you ready for this? The payoff for being a bondholder is a combination of buying a treasury bill that has the same maturity date as the bond, the risky bond in this case, and writing a put option on the assets of the firm that has an exercise price equal to the maturity or the face value of the bond. All right, so look at my little clouded statement there. Holders of a risky debt effectively buy a risk-free bond, and then they write a put option. And so this is the way it works. I mean, this should be really simple, and this should be pretty straightforward if I can give you just a quick example. Let's suppose that we have a risk-free bond that sells for $97 today and matures for $100. And let's suppose that we have a risky bond, in this case the bond issued by this bank or this company, that also sells for $97, but it matures for $103, right? So you got to have a greater return than that. What is that? Around 3% on the risk-free security, right? Well, what happens if the value of the firm is extremely high? Let's say $150 or $200 when the bond matures. Well, what happens? Well, the owner of that bond is going to receive the par value of the risk-free bond, which, what did I say, was $100. Plus, they're going to be able to keep the premium on that put option, which may have been, let's just say, $3. So that gets them up to the 103 future value of the bond. And so this is really cool to look at this as a combination of a treasury and a derivative security. And so if you look at the value of the debt there in that equation at the bottom, the value of the debt is going to be equal to the difference between F, which is the guaranteed risk-free payoff, and then subtract out that maximum of the payoff minus the value of the debt. And so if the value of the firm is only, let's say, $80 or $90, well, then the owners of that put option are going to exercise their right to sell at $100, and so then the bondholders lose out because they have, the bondholders lose out because they've written that put option. Now let's go ahead and extend this to the Black-Scholes-Merton option pricing model. Let me just remind you of some of these assumptions. Firm value is characterized by a log normal distribution. We spent tons of time talking about all the different kinds of distributions out there. And this is important there. There's a constant volatility. Oh, let's take a deep breath and just scratch our heads and say, okay, remember, we're back in, this is 1970 or 1972 when these three men came up with this idea. And a constant standard deviation was reasonable back in those days. Now, we'll pause and think about how we can relax that assumption. Now, we don't have to do that inside of this chapter, but as good risk managers, we're going to have to relax that assumption and figure out how to compute a changing volatility or conditional volatility. And I believe we've done that in a couple of other chapters. Interest rate must be constant. Trading is continuous. Financial markets should be perfect. That means no transaction costs and no bid-ask spreads and all that kind of stuff. What happens then is that this portfolio on the right-hand side of the balance sheet is going to be used to hedge these options on firm value. So portfolio value is equal to firm value. All right, now here's the equation. And I did some colors up here just to brighten things up. What I want you to do is I want you to look at the red. So the value of the equity over on the left-hand side, the equity value is equal to, and I want you to forget about everything else. Just look at the V minus the present value of F. That's the simple model that we used back in my first two slides. Now, what Black-Scholes and Merton have done is they have adjusted this simple model to include probabilities. And if you look in the green, the ND, and then the N, and I won't mention all those things, the D minus standard deviation, et cetera, those are going to be probabilities. So the only thing, and I say this almost in a silly way, the only thing that Black-Scholes and Merton added to our simple model are those probabilities, the NDs on either side. And they're going to be different probabilities, of course. And these are essentially probabilities that the option is going to finish in the money. So the Black-Scholes-Merton option pricing model is really just a probability-weighted, simple option pricing model that I showed you in those first two slides. And that's important. Everything that we did before, very simple, can be applied to this case. Now, I said it was a silly comment just a few moments ago because surely it was. Black-Scholes and Merton didn't only just add probabilities there. They used vast amounts of statistics and physics and all sorts of science out there to come up with exact probabilities that the options are going to finish in the money. Now, before we can get out our z-tables and estimate those probabilities, that's the ND, we need to compute the D. And the D is just the notation that Black-Scholes used because it was different than Z. So this thing is very, very similar to a Z-score that we talked about back in an early statistics chapter. And I bet lots of you remember from your old stats days, either in your undergraduate or graduate days. And so the D is really composed of two parts. It has a time value part and it has an intrinsic value part. And that's what the first part in there, the natural log of the ratio of the value of the firm over the present value of the face value of the bond. That's really just a measure of intrinsic value of the option. And then over there to the right of the plus sign is really just a measure of the time value of the option. So we're considering intrinsic value, we're considering the time value of the option, and then we're going to divide it by, some standardization, and we're going to divide it by standard deviation weighted by time. All right, so that's really all we're doing here to compute that D. And remember, when you compute that D, it's probably going to have a range of between, say minus 3.5 up to a positive 3.5. And then you can just find those numbers in the Z table. They're very easy to find. All right. And those are probabilities. So up in the green, those green values are going to be between 0 and 1. So think about what we're doing. We're taking the market value of the assets times the probability minus the present value of the bond times a different but related probability. So the Black-Scholes-Merton option pricing model, I love telling my students this, it's only the simple option pricing model adjusted for lots and lots of important things. And the thing that we ignored back in that first 2 slides is volatility. And so this is the cool thing that Black-Scholes and Merton did. They incorporated volatility into the simple option pricing model to come up with this thing here, the red and the green. Why don't we consider an example? All right, so here's firm value 100 million, face value of the debt 80 million, 3-year bond, interest rate 5%, volatility as measured by standard deviation is 10%. And so note we can go through and compute D. So there we go. There's all the D. And feel free to pause the video and get out your financial calculator or any calculator. Or maybe some of you guys are smart enough to do all that in your head. I certainly am not. And so you get a D of 2.241. We get out our Z table and we look up 2.241 on that table and we get 0.9875. And then we can come up with the second D, which is 2.0678, which translates into a probability of 0.9807. And so if we put those things into that equation there, we get, what is that, 98 minus 67? So the value of the equity here is about 31 million. All right, so this is important, right? What's the value of the firm? $100 million. What's the value of the equity? $31 million, which must make the value of the debt about, oh, am I smart enough to do that? Which must make it about $69 million, right? So 69 plus 31 gives me the 100. Face value of the debt is 80 million. Now remember, that's a 0 coupon bond, doesn't get paid for 3 years. So if you're a bondholder, what do? You pay 69 for it today and you hope to get 80 back in 3 years. If you're a shareholder, you're willing to pay 31 for ownership in this company. And what are you hoping? You're betting, I mean, let's face it, you're betting that that $100 million firm value goes up. You're betting that it goes up to 120 or 150 or 200. And how is that possible over the next 3-year period? Well, as shareholders, you elect a board of directors that hires a set of highly skilled executives. And those highly skilled executives, they find positive net present value projects over the next 3 years so you can buy low and sell high. So if that firm value goes to, let's say 200 million in the next 3 years, you bought at 31 today, well, maybe you'll sell at, I don't know, 100, 110, 120, 100, I don't know what you'll sell it at, but depends on all those different factors. Now, here's an interesting thing that your textbook does. It gives you an alternative way to compute this model, to compute the equity value using this model. And this is how I teach it to my students here. I have a D1 and a D2 rather than this. Well, let me go back to this slide here. Rather than that old slide right there, which I think is a little bit more complex. It's just, this is the way I was taught it this way, and so this is how I teach my students. And so I think the next one is just a recalculation using this model in a different fashion. It's kind of like rearranging the D1 and D2 formulas, but you still get the same answer there, 31. My advice is that if you have to compute this on an exam, that this is the way you do it. Because clearly the red, that's our simple model that we did back in the first 2 slides. And then the green are just those probabilities, and they're much easier to calculate this way, at least I think, than that other way. Either way, whatever you're more comfortable with. You know, I never tell my students that they have to compute future value or present value. The way I taught them, they can do it any way they want, as long as it makes sense and they get a correct answer and they don't use their neighbors. Now, how can we compute the value of the debt? I gave you a little bit of a hint there just a few moments ago about, what did I say? What was that? The 31 and the 69. So method 1 and method 2, they're very similar. In fact, they kind of complement each other. So method 2 is the easy way. All we're going to do is take the firm value and then add the value of the equity. What was that before? Geez, I'm drawing a blank. The value of the equity, 31. And the value of the debt, 69, what did that get us up to? 100, right? Or we can do it like that cool way that I described to you earlier. We can say, hey, let's consider the payoff of a risk-free bond and then the payoff of writing a put option. And so that's what that method 1 equation looks like there. That's why it has a minus sign in front of the put option. And then here's our example, and this is how you come up with the, what did I say, 69? So I was rounding, of course. There it comes out to be 68.78. So I encourage you to pause the video now if you want to go ahead and calculate all this stuff, but just based on our math from before, you know, this should be pretty obvious. Now, how about if we look at a table about the Merton model and how its inputs affect the value of the debt and the equity. So let's look at the 5 inputs into this model going across the top of the page. So value of the firm, face value of the debt, time to maturity, standard deviation or volatility, and interest rates. And how changes in those inputs will affect the value of the equity versus the value of the debt. So let's go back to Modigliani and Miller and 1958 and just remind ourselves, what's the goal of the business? Maximize the value of the firm. So how do we do that? We maximize the value of the debt plus maximize the value of the equity. That maximizes the value of the market value of the assets. But it's not as simple as that, because notice that sometimes there are pluses and then most times there are pluses and minuses on either one of these. And so this is really fascinating stuff, because sometimes when these variables change, they're going to increase one of the values, and sometimes they're going to decrease the other value. So let's skip to the bottom and let's do the value of the equity first. This is what I said earlier, right? What are we betting on? When we buy a stock option, a call option on a share of stock, what are we betting on? We're betting on the value of that underlying asset, the value of that stock, to rise by the expiration date of the option. Well, if we are valuing the equity of a business as a call option written on the assets of the firm, then we're betting on the same thing. We buy the share stock today, and what are we hoping for? We're hoping that the executives find positive net present value projects that will increase operating cash flows, increase branding, make something for pennies and sell it for dollars, however you want to word it, so that the value of that firm goes up. But the cool thing here is that as the value of that firm goes up, so does the value of the debt. All right, so that's why we have 2 plus signs there in that column. Now, the second column is interesting, right? The value of the debt, as the principal or the par value of the debt increases. In other words, as a firm issues more and more and more bonds, it becomes higher and higher and highly leveraged, right? And so when there's lots and lots of bondholders in line to be paid before the shareholders, then the value of the equity has to fall. But the principal amount of the debt, that'll just accumulate. So that's why there's a plus sign there. Time to maturity, of course, a 2-month call option on a share of stock is going to sell for a much lower price than a 2-year call option written on that same share of stock, assuming all of the other conditions and inputs are the same, right? So as the time to maturity on that bond issue, right? What did we use in that first example? A 1-year 0 coupon bond. The second one, we used the 3-year 0 coupon bond. So we could use 5 years or 10 years or 20 years in there. But it reduces the value of the equity for a number of reasons. But the easiest way to think about this is to use our knowledge of duration and convexity. Of course, longer term bonds have higher durations, therefore they have higher interest rate risk, higher sensitivity to yield changes, so that if the bondholder is forced to sell those bonds at some point between the issue date and 3 years or 5 years or 10 years, whenever that maturity date is, there's a good chance that if rates rise, then the value of that bond will fall by a greater amount because it has a longer maturity. Now, you should remember from call option pricing days that call option owners, they love volatility. They want to buy call options on shares of stock that do this, right? Because they have a greater chance of finishing in the money. They would never buy an option on a share of stock that does this over time because, geez, there's no chance of a substantial price appreciation. And then, of course, just the opposite happens in the value of the debt. So I want you to think about this from a capital budgeting standpoint. What do shareholders want? Do shareholders want the executives to buy and invest in risky projects or risk-free projects? And I always give the example of Milton Hershey in my class. You know, what could Milton Hershey do? He could wake up today and say, I want to make 1 million Hershey Kisses. And what would Milton Hershey know? He would know that if his factories made 1 million Hershey Kisses, they could sell 1 million Hershey Kisses because we've been buying Hershey Kisses for thousands of years, right? We know the brand, we know the quality, we know what we're getting out of it. Well, that's going to be low volatility, which means there's no growth, right? Milton Hershey has, it's a mature stage, so there's not a lot of growth. So that's why Milton Hershey woke up one day about 15 years ago and said, I want to do icebreakers. I want to do breath mints. This was a high-risk project. And if you go to the Milton Hershey webpage, you'll see all of these different product lines that have almost nothing to do with chocolate. And so shareholders, they want the same thing that the call option owners want. They want the firm to invest in high-risk projects to capture that right tail of the distribution. So that's why the plus sign is there under volatility. And of course, bondholders, they don't want volatility at all. They want Milton Hershey to wake up every day and sell 1 million Hershey Kisses, because then that increases the probability that they're going to be able to receive their interest in principal payments. I know there's no interest here in our zero coupon bond, but those interest and principal payments over the life of that bond issue. And then as interest rates go up, the value of the call option goes up, and so will the value of the firm. And that's because future values will go up because they can be reinvested at the higher rate. And again, just the opposite happens with the value of the debt. That should make perfect sense, right? As yields go up, value of the bond goes down. Oh boy, that was long. And I told you that would be the bulk of our slide deck. So let's go ahead and get into, the second part of this slide deck. And I'll probably be able to get through these slides a little bit quicker than those first ones. All right, credit spread. I bet you guys know what a credit spread is. This is just the difference between the yield to maturity on a risky bond and a risk-free bond. And so look at the quick example I have there. If we have two bonds, A-rated corporate bond has a yield of 10, Treasury bonds are yielding 8, then that credit spread is going to be a simple 2%. What does that mean? It means that in order for a bondholder to buy this A-rated bond, which the bondholder knows is going to have more risk than a U.S. Treasury bond, well, they're going to demand a higher return. So the only way you can get a higher return, the only way you can get 10% out of this is by paying less for the bond. That's why riskier bonds will sell for lower prices. Risk-free or low-risk bonds sell for higher prices because bondholders generally like those things, right? That's what we hear all the time. Whenever the stock market is crashing, we always hear that there's a flight to quality. And so bondholders sell their shares of stock, they go over to the bond market and they bid up the price of these treasury bonds, thus lowering the yield. Now, the credit spread can be calculated using this formula there. Notice what we're doing. Forget about that first part, the 1 over T minus the lowercase t. That's just an adjustment for time. But look at the natural log. So we're taking the ln of the ratio of the market value of the debt over the face value of the debt. And we take that natural logarithm just to turn that into a rate of return. That's exactly what we did to compute the rate of return on the intrinsic value back in the Black-Scholes option pricing model in one of those previous slides. Now, that first block point here is probably the most important in evaluating credit spreads versus time. So I'm going to read this to you, and this pretty much satisfies that one learning objective. As the time to maturity increases, credit spreads for both high-rated and low-rated bonds tends to increase. So this has everything to do with things like interest rate risk and things like default risk, because there's more uncertainty the longer the time to maturity. So, well, that's what I just said, that second block point. As time increases, so does a range of risks and other intervening events. And here's just a really simple picture of what I just described. Government bond yield curve there at the bottom, corporate bond yield curve at the top. And so what do we have over here? We have, relatively narrow credit spreads. We have a wide credit spread as we move to the right on the horizontal axis. Now, this is an interesting section in the chapter. It raises a secondary question. All we've done up to this point is value the debt and the equity, assuming there's only one bond issue and it's a zero coupon bond. But what about those firms? When you look on the right-hand side of their balance sheet, they have tons and tons of bond issues over there. Some of the debt is senior and then a bunch of it is going to be junior. And so how do you handle this when there is junior debt? Well, from the shareholder's perspective, right? The shareholder's perspective, it doesn't really matter a whole lot what the order is of those bondholders who receive interest payments before the shareholders receive their dividend payments. It doesn't really matter the order, it just matters the amount. So the more debt there is up there, then the greater leverage the firm is. All right, we did that back in one of those previous slides. But of course, bondholders care. Bondholders absolutely care if they're at the top or if they're at the middle or they're at the bottom. So you have the senior debt and then you have the subordinated debt below it. And so what we can do is we can just break up that zero coupon bond into its two components. So look at the bottom, the second bottom block point. The value of the firm is the value of the senior debt plus the value of the subordinated debt plus the value of the equity. I guess the text uses S for stock. So then you can kind of rearrange that. And so the value of the equity is given by this call option pricing formula. And it's similar to what we had before, but now you have to worry about the market value of the assets being sufficient to be able to pay off the senior debt and pay off the junior debt. So it's kind of like, I don't really want to call it a compound option because that has some other implications. But the owner of a share of stock then has multiple options. One option written on the senior debt, one option written on the junior debt. And of course, those options are related. And the shareholder is betting that the market value of the assets is going to exceed the combined value of the junior debt and the senior debt. And that's what I did right here in that middle equation, right? So the value of the senior debt is the value of the firm minus the value of the option held by the equity and the subordinate debt holders. So let's go ahead and do just a quick example here. So we've got 140 million value of the firm. Remember, that's market value of the assets. Subordinate debt face value 60, senior debt value of 100. Both of these mature in 5 years, interest rate 10, volatility 20. What we want to do is determine the value of the junior debt or the subordinate debt. So I want you to think about this, first of all, before I hit the next slide button. The firm is valued at 140. Now, this firm has issued 2 bonds. one with a face value of 60, one with a face value of 100. Now remember, those are not market values. So don't think that that 140 has to equal the 60 plus the 100, which gives you 160. Remember, what we're doing here in this Black-Scholes Merton model is market values. So we're essentially going to compute those two market values, and this is what we do here. Now I'm not sure why the textbook does it in this manner, but it does. So let's look at that first block point over on the right. If we ignore the subordinated debt, the call option is going to be worth about, what is that, about 80 million. Let me go ahead and round. And so there are the inputs and there are the outputs. So you can do the D1 and the D2. And notice we did this here in that second, using that second model, which is the one that I like. So if you do that, you get the 7973. Now, look at the second part down here. Without ignoring the subordinated debt, the call option is worth only $48 million. And so the value of that subordinate debt is $31 million, right? So look at the bottom there, senior debt. We've got 60.27, right? We calculated that up at the top. Then we have junior debt, 31 million. We calculated that at the bottom. And then we took the difference there to get the equity of 48 million. So we've got 60, then 31, then 48, and that sums to the $140 million. So think of the balance sheet that looks like this. We've got the assets over on the left-hand side working, right, generating cash flows. They're worth 140. Well, we've got senior debt worth 60 and then junior debt worth 31. So you sum those, that gets you what? About 90 or 91 million. And so then the difference has to be that call option down at the bottom right-hand side of the balance sheet. And that's the equity value of 48. Now, there's a little bit more subtlety to looking at the volatility on the subordinate debt than what we had in one of those previous slides, all right? And your textbook calls this an ambiguous effect. And I think this is really cool. And this is really, for me, this is the best part of this subordinated debt conversation, because you can go back here and this is really an application of what we did in those previous slides. So the math here ought to be okay. But I love being able to back this up with some interesting conversation. All right, you ready for this? So I'm going to read this. If the value of the firm is low, now that doesn't mean low like close to zero, but relatively low in relation to the value, the face value of the bonds, there's a good chance that the subordinate debt will not pay off. All right. So that position in the derivative, in that call option, is economically important. All right. So look at the bottom there. As a result, the subordinate debt is almost similar to equity. It acts an awful lot like equity, and that means that it's an increasing function of the volatility of the firm. So if you're a subordinate bond holder, and your option is, boy, a little bit out of the money or maybe just a little bit more out of the money, what you want is that firm to invest in high-risk projects so that they can capture the right-hand tail of the distribution so that you can go from not being paid to being paid the full amount of your bond issue. However, if the value of the firm is really, really high, like 200 versus 100, then your probability as a subordinate bondholder, as a junior bondholder, is that you're going to get your interest and principal payments. And so notice what I have written there. The subordinate debt is almost similar to senior debt in that it is a decreasing function of volatility. So on the left-hand side, if you're a Hershey junior bond holder and you're out of the money, you want Milton Hershey to wake up and invest in all sorts of crazy candy bars and even other things. Maybe you want Milton Hershey to start making soap, Hershey's chocolate soap. I mean, whatever that means. Lots of risk means there's lots of a payoff so that you can increase your probability of being paid. But if you're a junior bondholder with Milton Hershey and the cash flows are super high and the value of the firm is super high and Milton Hershey only owes you this much, well, you want him to continue to sell Hershey Kisses every day so that you have that giant buffer. And so I think those bottom two sentences are really important. I would just memorize those if I were you. And so here's kind of a summary of what we just described and how those three important factors relate to the value of the senior and the junior debt and the equity. Now, remember that we made this assumption that interest rates are known and constant. Well, what do we know about interest rates? Of course, we know interest rates do this, right? Interest rates go up, interest rates go down. So notice that first block point. Unanticipated changes in interest rates can affect debt value through two channels. First, we've talked about this before. When yields go up, when interest rates go up, then present value of the bonds go down because the present value of those coupon payments and those principal payments, they have to fall, right? So there's what we know all the way back from our very first introductory microeconomics or macroeconomics class about the relationship between interest rates and bond prices. Now, the other part of this is that now this is tending. This is not guaranteed, but tending. When interest rates rise, stock prices tend to fall. All right? So there's a potential effect in which increases in interest rates are going to reduce the value of the equity because there's a negative correlation between interest rates and stock prices. Now, this doesn't always hold true. It doesn't always hold true. And in general, this doesn't have anything to do with your chapter. I'll just give you a little sidelight here. You know, those change in interest rates, whether they're up or down, you have to look at them in terms of how the total economy is going. I mean, if the economy is expanding more rapidly than rise in interest rates, then who cares about the rise in interest rates? I mean, right, we care about expanding economy so firms can capture those positive net present value projects so bondholders and shareholders can buy low and sell high. Now, of course, it's a little bit more complex than that. We might care about rising economies, et cetera, et cetera. All right, so notice the second block point. Since the model does not allow for stochastic interest rates, alternatives have been developed. And one such model is this Vasilchek model, which is really fascinating and coincidental and ironic because I just gave my senior students an assignment using not the Vasilchek model, but the Cox-Ingersoll-Ross model. We're going to do Vasilchek model next week. And so what this does is, here's the model. What it does is it allows interest rates to change based on a couple of different factors. And the important part of these factors, the important part of these models is that this concept of a reversion to the mean holds true in lots of variables that are out there, but certainly with interest rates, right? When interest rates are low, they're probably going to rise. When interest rates are high, they're probably going to fall. So reversion to the mean plays an important role in the interest rate paths over the lifetime of a zero coupon bond that we're using back in the models so far in this slide deck. And coupled with that interest rates go like this. And so some interest rates go like this and some just go like this. So we need a measure of volatility. And so that's really what this Vasilchek model is. So let me go ahead and work through this here just quickly. I mean, the good news for you guys is that the learning objective doesn't say, go ahead and compute the new interest rates and the new term structure using the Vasilchek model. But it does want you to understand and to be able to explain what these components are and how valuable this is in putting together some kind of a price on a bond and a share of stock as viewed like we have so far in this slide deck. So look on the left-hand side of the equal sign, there's the delta R. So we're measuring the change in R, and look inside of the parentheses over on the right, there's an R sub T. So we start with R sub T, but what we're solving for is what that change in the interest rate is going to be. Theta On the other side of inside of the parentheses is the mean value of interest rates. All right, so if the mean value is 5%, then if rates are lower than 5%, then that change is going to be positive, right? And if rates are higher than 5%, then that change is going to be negative, and you can see that inside of the parentheses. And then the lambda there is the speed at which the interest rates reverts to its long run mean value. And this is really the challenge of this model. I mean, you can come up with some reasonable estimate for a mean reverting value, but the speed with which mean reversion occurs is really a challenge. I mean, how do you say, okay, we're going to really get to that mean really fast, meaning that if the Fed lowers interest rates to lower than its mean value, then the Feds are going to turn around the next day and increase interest rates. I mean, of course, we know that that doesn't happen. And so that speed is going to be, maybe 0.1 if it's relatively slow, or 0.6 if it's relatively fast. And then we're going to multiply that all by delta t. So delta t for 1 month, if we're going to do this monthly, that would be 1 month. And then if it would be 2 months, that would be 2. Or we can do it as a fraction of a year, depending on how you want to structure the whole model. And so notice that first part in between the equal sign and the plus sign, that is really a measure of how quickly and how much time does the interest rate have to change. And then we're going to adjust it by its volatility. And so note that lowercase sigma sub r, interest rate volatility, and then we have some error term over there. And this is not like the error term in regression analysis where the expected value of it is 0, et cetera, et cetera. We did all that stuff. But this is like a random economic shock, like the financial crisis of 2007, like the coronavirus issue of 2020. So I hope that's enough for you to address this learning objective about explaining this. So what are we doing here? Just a quick summary. We're going to see that interest rates change over time, and stochastically they can change over time as a function of the principles of mean reversion and the principles of interest rate volatility. So I think if you remember those two things and then add some kind of an economic shock, you ought to be able to answer questions on that. Now, how about if we use this model to compute a probability of default and a loss given default? And so we're going to use all the stuff that we learned here, maybe rearrange it a little bit. And so just skip down to the blue equation there. So our probability of default is going to be a function of, the market value of the firm, the market value of the bonds, and we're going to adjust that through expected returns and times and volatility. There's a standard deviation over there. So we're going to use all of that. And then remember, the n, that's our cumulative normal distribution function. So we're going to get a number inside the brackets, look that up on the table, and then we're going to get a probability of default, right? Like 2% or 8% or 29%. And then at the bottom, we can compute the loss given default, much like we have done in previous chapters. We're going to take that probability of default, right? That's the blue part. And then I highlighted that in bolded. It's not quite black. It might be dark purple or something there. And that's really just based on what we did in that original Black-Scholes-Merton model from many, many slides ago. So we can use that model to compute not only the probability of default, but also the loss given default. All right, how about credit risk portfolio models? All right, so this is essentially what we're trying to summarize based on what we did in the past. All right, so these credit risk models have been crafted to use parts of the Merton model, but also to move through and address some of those weaknesses and, in fact, try to strengthen those. we said this before, that Merton model assumes lots of things, but one of the important parts is just only the 1 0 coupon bond. But of course, that's hardly true in practice. Now, we did an exercise where we did a senior debt and the junior debt, but what happens if you have a whole series of bond issues on the right-hand side of the balance sheet? What you can do is you could probably average some of those together and maybe take an average or maybe figure out some kind of a statistical way to group those together. But it's better. It's much more efficient to do something else. And so that's what this credit risk plus model does. What it does is it uses a set of common risk factors. So we got to go back to Stephen Ross and the factor models and even the arbitrage pricing theory, where that each borrower is pretty sensitive, maybe even uniquely sensitive to these common risk factors. Of course, if I borrowed money for something, I would be sensitive to repay this based on my income as a professor, right? And other people are sensitive to their own income levels, but I might have a unique sensitivity to income teaching at a college. Let's suppose that a certain presidential candidate gets elected here in the United States and makes college education free, and maybe I'll double my salary, or maybe I'll lose my job, depending on lots of different factors. But clearly, I'm more sensitive to that kind of economic information. I'm uniquely sensitive to that versus other people who work as accountants or lawyers, and they wouldn't be affected by that piece of legislation. At least their incomes wouldn't be affected, maybe in other areas. Now, this credit risk plus model only allows for two outcomes, right? Default or no default. And so that probability of default depends on credit rating and those risk factors and the sensitivity to those risk factors. Now look at that bottom one here. I would memorize this statement here. The model assumes that defaults are uncorrelated across borrowers. So if I default, that doesn't mean that this dude over here is going to default, or that woman across the street is not going to default, or that any other professors are not going to default. Now, the CreditMetrics model, which of course has been trademarked, is useful to assess portfolio risk due to changes in the value of that original bond because of changes in the obligor's credit quality. All right, so we're not just concerned by possible default events. What was that last one? Default or no default. Back here, let me just go back quickly. Back in the credit risk plus model. But here, we need to concern ourselves with upgrades and downgrades in credit quality. And, forget about me as an example, but suppose we're a financial institution and we have a bond portfolio out there. And I'll just use Milton Hershey and Nike since, I've talked about those two companies in this particular video. So those two companies, they probably have different ratings, and one might be upgraded, one might be downgraded, and those upgrades and downgrades might be related and they might be independent. And so let me go ahead and read these last two block points because I think these are important here. The value of the bond for each rating class in a year is computed in a probability that the bond will end up in each one of those rating classes is assigned. And what that does, of course, as you think about it like this, you have this and you have this and you have this, and you have all the way over here to this left-hand side, which means that this model lends itself to using value at risk. Now, this KMV model is going to be a direct application of the Merton model in computing the probability of default. What it does, however, is that it allows for short-term debt, long-term debt, and even convertible debt on the right-hand side of the balance sheet, and then it's going to use those current market values of equity. Look at that third bullet point, that third block point from the bottom. The impact of a current event does have an effect on the probability of default. And for my thoughts, this is the big advantage of the KMV model. All right, we're winding down here. Have some more patience with me. Credit derivatives. So what do we know about credit derivatives? These are things like credit default swaps, which I love talking about in my class. Collateralized debt obligations, which I also love talking about in my class. I love breaking these into their different slices or their different tranches and having my students try to figure out which one of those slices is relevant for a particular client. And then there are other kinds of obligations there. Total return swaps, credit spread swap options. When I teach my derivatives class, that's always the last topic, a option on a swap contract. Well, what do these things do? What they allow investors to do is to participate in opportunities that previously were not available to them. And essentially what that does is transfer credit risk. And that's why I have that bolded up in the top. And these credit derivatives are over-the-counter instruments, meaning that you could show up at Wells Fargo financial institution and say, hey, I want to buy a credit default swap on Jim's loan that he took out to buy his John Deere tractor. The bank would probably scratch its head and said, the tractors cost, $2,000. We really don't want to waste our time for that. But clearly, if there were enough demand for that kind of an instrument, then Wells Fargo would do that. And of course, they would do it, and they would do it as often as the market allows. All right, so let's go ahead and skip down to the payoff. So the payoff depends on the occurrence of a credit event. Failure to make a required payment, restructuring, cross-default clause, and of course the big one, which is bankruptcy. And I always tell my students when thinking about a credit default swap is that, this is almost like an insurance contract. It acts like an insurance contract. There's that transfer of credit risk. And so if Milton Hershey doesn't pay the bondholders their $100 par value, then the financial institution will step in and make that payment. So it's a transfer of credit risk. And if you look at these things as kind of like other contracts, maybe they're insurance contracts, maybe there are some kind of other financial contracts, but of course, these derivatives are contracts, legal and binding contracts, but they serve a specific purpose. And lots of times it's mostly just because investors are standing on one side of their fence and they're looking over at the other side of the fence and they're seeing all the people over there having a great time and they want to say, I want to be on that side of the fence. All right, credit default swap. One party makes a payment to the other party and receives in return the promise of compensation if a third party defaults. That's a standard definition of a credit default swap. Bank A buys a bond issued by ABC Company. In order to hedge that, Bank A could buy a credit default swap from any kind of a financial institution. The bank will make those periodic payments to the insurance company. Just like I make periodic payments for my homeowner's insurance, I make periodic payments for my auto insurance. And what happens with my insurance, if something happens to my house, then the insurance company will come in and reimburse me. If something happens to my car, the same thing. But I make those payments with the hope that I don't ever have to use my car insurance because I don't want to wreck my car and I don't want anyone to wreck into me. And I don't want my house to burn down or have a flood in the basement. Well, it's almost identical with a credit default swap, but we're insuring a financial asset like a bond instead of a physical asset like a car. Total return swap. This is exactly like I described looking in the back of the yard. Suppose that you're standing in your backyard and you look over the fence and you see your neighbor, and your neighbor owns the S&P 500 index. And the S&P 500 index, every day it goes up 5% and 2% and 3%. And over here, you're getting a fixed dividend payment. And all you're getting is 50 cents and 50 cents. And all you're doing is taking that 50 cents and you're not very happy. And you look over there and you say, boy, I would like to have a swap. Will you pay me the S&P 500 index and I'll pay you my fixed dividend payment? This is the classic fixed for floating equity kind of a swap, but it doesn't have to be fixed for floating. It could be floating for floating. I could own the NASDAQ index and my neighbor could own the S&P 500 index, and we're just going to swap those payments. Now, the interesting part of this is that if you swap fixed for floating or floating for floating, you can end up on the negative side of both of those swaps. Total return swaps are really super cool. How about the credit risk of options? So look at this new terminology. A vulnerable option is an option with default risk. All right, so the option holder receives the promised payment only if the counterparty is able to make that payment. What happens if the counterparty says, hey, I have the money, but I'm not going to pay you, or I don't have any of the money? So the payoff of the option looks exactly like it did before. But the vulnerable option holder receives the promised payment only if the value of the counterparty at maturity is greater than the required payment on the option. So therefore, we have to take the maximum of 0 or the minimum of the difference between the exercise and the underlying asset price, or the value of the bond. Now, this last learning objective asks us to look at the accounting for credit risk exposure in valuing a swap. And so let's go ahead and use the example that I did in our backyard, swapping the NASDAQ index for the S&P 500 index. Now remember, we're probably going to do this quarterly. And we're going to net the payments, right? If my neighbor owes me $100 and I owe my neighbor $110, well, we're not going to swap. We're going to swap the net payment. So I'm going to just pay my neighbor $10. And so the payoff of the swap to the market maker, in this case, I guess there's somebody in between my neighbor and me standing on the fence. It can be summarized by, look at this. So we're going to take the maximum of the difference between, excuse me, that fixed amount at maturity and the swap payment, and then the minimum of the difference between those two and the value of that credit, that risky credit. And so notice we have a minus sign under the max and a plus sign, a minus sign under the first max and a plus sign before the second max. And so what we're doing is really just saying, all right, he has a value, he or she has a value, your neighbor, and we have a value on this side. And so that's how we're going to account for it. And I think that takes us through this chapter. That was a long one. Thank you for your patience.